The Milken Institute Global Conference is the culmination of the important work our centers do throughout the year and helps inform our agenda going forward. Each of you participating represents extraordinary expertise, an ability to mobilize significant resources, and a sincere desire to be a force for good. And for that, we could not be more grateful. It is my honor to formally acknowledge and thank the group of people who make this event and all the great work we do possible, our supporters.
Hi, everybody. My name is Erik Schatzker. I'm an editor-at-large, Bloomberg Television, and I welcome you to the Milken Institute's Global Conference panel on capital markets. It's great to see all of you, and I'm so glad you could join us. We have a distinguished panel. As always, today you can count on Milken for putting together the very best panels. Catherine Keating is the CEO of BNY Mellon Wealth Management. Scott Minerd is with Guggenheim, of course, a name you recognize well. And Rajeev Misra is the CEO of SoftBank Investment Advisors. He runs the Vision Fund. We're going to have a healthy discussion about the health of capital markets today. And I'd like you to participate. As always, the Milken Institute welcomes audience participation. You'll see a dialog box on your screen that allows you to submit questions. They'll be received by the folks at Milken, who will then pass them on to me, and I'll do my utmost to integrate them into the flow of our conversation about capital markets. Think about the relative expertise that each of our panelists bring to this conversation. You're welcome to ask questions of them individually, but I would prefer that you ask questions each of our panelists can take up. That's what I'm going to be doing my best to accomplish in the course of the next 60 minutes. Catherine, Scott, Rajeev, good to see all three of you.
Good to see you.
Thank you.
Great to be here.
Thank you.
Without further ado, I think we should begin. That's what everybody's waiting for. So here's where I'd like to start. I had a recent conversation with Ray Dalio, the founder of Bridgewater Associates. And in that conversation, he made, as he often does, some very provocative remarks, specifically about capital markets. He said capital markets are no longer free markets, allocating resources in traditional ways by virtue of its interest rate policy, the amount of liquidity it has injected into the financial system, and its purchases of credit assets. Ray told me, quote unquote, the Fed is the capital market. So Scott, why don't you start us off with an assessment of the health of capital markets today in the midst of what is still a global pandemic? Is Ray right? The Fed is the capital market?
You know, as usual, most of the time, Ray and I agree on things, and I think he did a better job of describing it than I would have. But, you know, the real impact of this, Erik, is it's caused a repricing of risk assets, which no longer necessarily reflect the risk associated with them. You know, for instance, if you take bonds and high yield bonds, and you look at the kind of credit spreads that are available relative to U.S. Treasury securities, it's arguably not enough to compensate you for what is expected to be the ongoing defaults. The other aspect is the property market has made equities more competitive as substitutes for fixed income assets, along with reducing the cost of capital, which is causing stock prices to rally. And then I think the third thing that is of real importance in the long run is I think Deutsche Bank came out recently and made a statement that at least 20% of all the companies in the S&P 500 are they don't have they don't make money, they don't have positive cash flow. And I think we're all familiar with a lot of those. A lot of them are airlines, of course, in hospitality, energy. There are a lot of different categories, retailing. And keeping these companies alive by providing access to credit is essentially going to result in more severe price deflationary pressures, and is going to, in the long run, reduce the overall productivity of the U.S. economy.
So, Scott, I don't want to put words in your mouth, but it sounds to me like your assessment is that what you've just described and what Ray was referring to is not a healthy capital market. Am I being fair? And if the market isn't, if the capital markets are not healthy, besides what you just described there, the risk of, or the risk that we have zombie companies that are at some point, going to collapse into whatever, hard to describe, hard to predict. What are the implications of an unhealthy capital market?
Well, I mean, the what I'll call irrational pricing of capital is causing corporations and households, it'll come in time, and even municipalities to become over levered. The corporate bond market, before we got to where we are today, the total corporate debt outstanding at the end of last year was the highest on record as a percent of GDP. Since then, it's only gotten worse. And so with so much leverage underlying the system, you either end up one of two ways. You end up with systemic risk, which means you have something akin to the financial crisis or worse, or you go down the road of socialism. And, that is, of course, politically destabilizing and would change Americans' lives for the foreseeable future the more we move that way. And so those are the two options in the long run. And at this stage, it's a battle. We'll see one play.
Catherine, let me turn to you. What Scott just gave us are two unappealing alternatives, right? Systemic risk on the one hand, socialism on the other. Share with us your view on the health of capital markets, and perhaps as well, it accompanies the underlying health of the economy.
Sure. So let me start with Ray and the Fed and capital markets, and maybe a little context would be helpful. If you think about it, obviously we know what interest rates have done over the last decade and of course over the last 6 months. But if you just step back a little bit and say, so what was the role of the Fed? What was the size of the Fed as recently as 2008? The Fed's balance sheet was $800 billion. And then we went through the financial crisis and we saw the balance sheet start to grow, $2.5 trillion. Then we saw quantitative easing up to $4 trillion. Well, now we're at 7 and we think it's probably going to grow to 8. So that's a 10 times the size of the Fed's balance sheet, and that's an enormous support for capital markets. And so if I look at just things like PE ratios, okay, the global economy has shrunk by roughly 10%, and yet you see PE ratios at the top of the range over the 25 years, over the last 25-year average. In the same way, you see interest rate spreads toward the bottom of the range over the last 25-year average. And that, again, that's very unusual when you have an economy that's, shrunk by 10% around the world. So the Fed has an enormous impact on capital markets. But to your question, Eric, so does the economy, obviously. So does the economy. And, when we look at the economy in this country, we've clearly seen a V-shaped recovery in capital markets. But we've begun to see a V-shaped recovery in really important sectors of the economy. Housing, manufacturing, technology. These are durable goods. These are things that are going to propel the economy to grow at a time when it really, really matters.
So let me follow that, Catherine, by asking you to imagine the alternative. What if the Fed hadn't cut interest rates to near zero again? What if it hadn't pumped trillions of dollars of liquidity into the financial system? And as you pointed out, there's more to come. What if the Fed hadn't become the buyer of last resort for investment grade credit and fallen angels? What would the capital markets look like today? And what would the economy look like today, for that matter?
So the answer is, I think we would have had, first of all, we had fiscal stimulus plus the Fed and monetary stimulus. And I think the two together have really helped us avert something that could be quite serious, right? Again, I'm talking about the economy in the US being down 9, 10%. Only down 4% in the financial crisis. So we're talking about something that without all of this monetary and fiscal stimulus would have been very, very serious, and probably one of the most serious in the last 100 years. So, the actions were taken. They were done very, very quickly, very, very effectively. We sort of look at the fiscal stimulus as kind of the bridge, to the vaccine and to improvement in the virus. And we look at the monetary stimulus as something that will have a longer life as the economy continues to heal.
Rajeev, let me turn to you for your thoughts on where we are in capital markets. Ray's point about the Fed, you've just heard from Scott about the irrational pricing of capital, the unsustainable amounts of leverage, what you've just heard from Catherine on the PEs and credit spreads being both at the high and the low of the range over the past quarter century. And tell us what it looks like from your position at SoftBank running the Vision Fund, a very different point of view than what we get from at Guggenheim or from BNY Wealth Management, for that matter.
Well, I'll speak for equities because I spent 25 years of my life managing credit, but let me say a few words. And I oversee both the Vision Fund, which is between Fund 1 and Fund 2, 100 billion in assets. And I also oversee SoftBank's entire portfolio, where excluding the Vision Fund, we are long close to $300 billion of liquid assets, especially after the sale of ARM to NVIDIA. We're long 36 billion of NVIDIA, 170 billion of Amazon, of Alibaba, and a whole host of other stocks that add up to 300 billion. So we're long, 300 billion plus of equity exposure, mostly public, some private, and you heard from my other panelists about what the Fed is doing. Of course, the bottom line is they've reduced risk premium to zero, which is what central banks are doing across the world, put more liquidity in. Can't complain when we are long 300 to 400 billion of assets, so I'm not going to complain about it. Right or wrong, it is what it is. And I don't see inflation, which basically comes from a few components, which is wage inflation picking up in the next couple of years, even if we have a lot of infrastructure funding and so on that employs a lot of people. Wage inflation is still far from showing its head. Hydrocarbon or lead inflation, oil, I don't see that for the next couple of years. And food and other essential, I don't think will add much to inflation for the next couple of years. So I basically see risk-free rates staying close to where they are, or for the next few years. Of course, as my other fellow panelists said, it creates agency problems in the system because companies that shouldn't exist will exist. Companies that shouldn't be raising equity capital can do so by going public directly or through SPACs, etc., etc. So there will be some agency problems. Every good thing has a few issues, but by and large, I guess we can debate right or wrong. It is what it is, and I believe history will tell us in a few years' time, like it did for 2008 and 9, that net we needed a floor, we needed a safety net, which has been provided.
So I could easily move on to another topic. Yeah, Scott, I was actually going to turn to you and also to you, Catherine, as well, because Rajeev threw the eye grenade into the conversation, which is inflation. And without turning this into too much of a panel on Fed policy and, macro risks, I think it is important to take up that question, because whether inflation does rear its ugly head or not has enormous implications for where rates are and subsequently, of course, where capital markets are in the years ahead. And I don't know if that's what you wanted to take up, Scott, but perhaps you could jump on that and anything else you want.
Sure. Well, just let me quickly ask Rajeev, has the arguably extended valuations of assets and opportunities made it your job more difficult to find opportunity?
Amazing question. So, again, let me say, I wear two hats. We manage third-party money, Scott, 160 billion, between 110 billion in Variant Fund 1 and 2, and another 50 billion in something that's similar to yours, Chris. And then we have 300 billion of our own assets on our own balance sheet, SoftBanks. We're not answerable to anybody for that. So, but if you look at the last 9 months, it is extremely difficult to deploy capital. I mean, we, after the sale of ARM to NVIDIA, have 100 billion, close to 100 billion of cash, give or take, depending on regulatory approval. Sorry about the dog. We cannot deploy capital because anybody who needs $1 billion or $2 billion of capital that we could deploy earlier can go to the public markets. It's so private investing, and that is the seesaw. 2018, private markets were the source of capital and were the new public markets, as people called it. Now the public markets valuations are substantially ahead with better valuations. So yes, it's very difficult to deploy capital in a nutshell. The last 6 to 9 months, very difficult. Because why would you take money from us when you can get a better valuation with no strings attached from the public markets?
So that seems like a worthwhile question to put to each of our panelists, and it is, in fact, our first question from the audience. And Rajeev, I'll stick with you. Given the fact that it is difficult to deploy capital, where do you see opportunity at the moment?
Not to deploy capital, to divest assets. I mean, it's very difficult. I mean, we have
so
presence.
Your bias is toward selling versus buying.
Well, by choice, we have sitting on, I said, close to 100 billion of cash from the divestment of ARM. We monetized a lot of Alibaba, etc., hoping we'll see opportunities to deploy capital. That was in March. We thought, hey, we're getting into a crisis. Let's prepare a balance sheet. Let's get ready. And here we are with a lot of cash. And, having said that, these things change. I mean, investing, as Scott can tell you, is a long-term game. I'm not complaining. When you're long 300-400 billion of assets, I'm not complaining. About the Fed or about the fact the markets are robust and the public markets are robust, that's great news. But if any of us were an entrepreneur looking for capital, the public markets are the best option today.
So I'll turn the question to both you, Catherine, and to you, Scott, starting with you, Catherine. Given everything that you've articulated, your fellow panelists have articulated, is there opportunity? People have said, I think, in fact, you may have said, the 60-40 model doesn't work anymore. You can't, hope that you get some kind of ballast out of government bonds for weakness or volatility in equities.
Yeah, so I'll take the question you asked first and the second one. So the first one was really about inflation, and it's really important, Erik. No investor can take his or her eye off inflation. It has an enormous impact on accumulation of wealth over time. And we started this year telling our clients, before we knew about the pandemic, that we weren't particularly worried about inflation for one big reason. And that reason is demographics. We see all the major economies in the world aging at the same time: US, Japan, China, Europe. And that really matters. In this country, the average age was 28 in 1970. I think it's 38 today, and it's going to be 40 pretty soon. And we know what happens when economies age. When economies age, GDP growth tends to go down. Inflation tends to go down. Yield curves tend to flatten, and market returns tend to go down. And the truth is, we've been seeing that for this whole new century that we're in since 2000, right? You think about the market returns that people enjoyed, equity market returns in the 80s and the 90s, double digits pretty much across the world. We haven't had that since 2000, and we have had lower GDP growth, and we think the fundamental reason for that is demographics. Now, fast forward to March of this year and 150 basis points of interest rate cuts, and yes, the 60-40 portfolio isn't going to do for you what it used to do. We look at that 60-40 portfolio. Our clients, tend to have diversified portfolios, investing for the long term. If you look back at the last decade, that well-diversified 60-40 portfolio probably did about 7%. Looking ahead, without any adjustments, it's probably going to do about 5%. So we're looking to find that extra 2%, and some of it we're doing in private markets. Private markets have pretty reliably delivered a liquidity premium above public markets, as you know. But we're also taking down fixed income allocations. That 60-40 probably won't be a 60-40 anymore. It'll be a 65-35, and looking for additional sources of return in equities and private markets and real estate and in hedge funds.
And you, Scott, where does an investor like Guggenheim go in a world that's starved for yield?
Well, I mean, it's really interesting. I think that the Fed has made my job easy for the time being. And that is when you look at where credit spreads are today, and you look at over the last 35 years where the tight spreads relative to treasuries and the wide spreads, today credit is still cheap versus the average. It's around the 60th percentile. If we go back to the tights, which we have in every cycle, and given all the liquidity seems inevitable, we're going to be in a world where securities are trading at levels that we never imagined. And I personally think we could see junk bonds at like 1.5%. So I think credit is an easy bet. We know the Fed isn't moving for the next 3 years, and I think going back to the inflation question, I do agree that all the money printing is ultimately inflationary. But a lot of people, when they quote Milton Friedman, kind of. And that is that, inflation is always and everywhere a monetary phenomenon. But he goes on to say, subject to long and variable lags. And I think we're in that phase of long and variable lags that ultimately we will get to inflation, but it's not going to happen in the next few years.
Is that to say, Scott, that...
Go
ahead. Is that Rajeev? Were you going to jump in, please?
Yes, I'm going to jump in because Scott's talking about credit, which is my second favorite after equity. So did 25 years of credit. So, we all talk about historical data, okay? And we're going through some seismic shifts because we saw that in the mid-2000s when China became the factory of the world and produced goods substantially cheaper, which had a big impact on inflation. I think here at 2020 onwards, and what has further accelerated over the last 6 months because of COVID, is we are getting into a new digital economy which will deliver goods and services substantially cheaper as people and their behaviors change. The last 6 months, we have dozens of companies. Dozens means 50, 60, 70, 80 companies that are in online education, online e-commerce, online life sciences, selling used cars to, food delivery to dark kitchens to what have you. All 80, 90 companies in that sector. And the amount of market share they gained in the last 6 months, this is important, is equal to the previous 4 years. At no cost, customer acquisition. So it's whether it's from payments or whether, and it's not, it's our generation. It's the 40 to 70-year-olds who are now logging in to get their entertainment, their food, their used cars, their sneakers, to what, they're buying their insurance policy, and that is going to be that's going to help with lower inflation because that's being done at a much more cheaper and a price competitive basis. So let's not extrapolate historical data when we look at inflation. So again, I'm
Well,
with
let me address.
And I think, Rajeev,
Catherine,
I think you make a very important point about technology, which is technology doesn't just drive the stock market. Of course, it has enormous impact on the stock market, but it has come to be the case that it also really drives the economy, and that's what I think your comments really point to. It drives retail sales, it drives capital expenditures, it drives industrial production, it actually drives employment in this country. Whether you work for a tech company or not, chances are you're increasing your technology employment. And so technology really does drive the economy today.
and Scott, you were about to say something as well.
Well, I was going to Rajiv's comments. I don't want to be misunderstood. I actually agree with you, Rajeev.
No, I'm agreeing with you.
At,
I think risk spreads are going to come in.
Yeah, it's just that, I look at the spread opportunity, and I'm on record, to just throw a hand grenade into the room of saying that I think that U.S. Treasury rates are going to go negative. And so, you're not going to have negative Treasury rates when you have high levels of inflation.
So, I don't want to overinterpret what each of you has said. Trying to do that as a moderator is a dangerous thing, but it does sound to me as though, to varying degrees, all three of you agree that investors can, at least for a period of time, afford to ignore this disconnect that we have established between what's going on in corporate fundamentals and the state of the real economy and what we can observe in capital markets and valuations. Is that fair?
That's a bit strong because corporate fundamentals, you will see in the next 3 weeks earnings come out for Q3. I'll bet you that more than 50% of the companies will beat earnings estimates. It's not going to be that bad, number one. And stock prices, present value of future cash flows, when the discount rate, as Scott said, is close to zero, going negative. That's second. And I think where the most of the valuations growth in the stock market has come has been companies that are disruptive. I'm not going to say that technology companies. You just have to be disruptive in the model. You could sell online insurance where you'd sell it at half the price using technology as an enabler. That's not a technology company. It's just a disruptive company. And using disruption, those companies are going to do very well.
And I think it's fair to say that there's
agree
always
with
a disconnect. Sorry.
Catherine, it's okay. Why don't you continue, Scott? We'll come back to you.
I think there's always a disconnect between the stock market and the economy to a certain extent, right? The stock market looks forward. It's trading on expectations, what it thinks the future holds. Economic data is always looking backwards. The stock market is big companies. It's mega cap America, and half of America works in small businesses. So there's always a disconnect between the stock market and the economy.
That is fair. Scott?
What I was going to say is that if you believe what I'm saying, equity prices will be substantially higher from where we are today. The real issue, I think, in equities, the economy and other economies come back online. All the capital that's run to technology, what people call technology. I doubt selling things over the internet is really technology. But all of these darling stocks, the five that are driving the U.S. market, for instance, will eventually have to to give way to letting other sectors catch up. And so there is a point here to, if you're in equities, to consider rotation into things that are more value oriented. But that, of course, is a trade. Technology in the long run is the place to win. But as I advise people, what Baron von Rothschild said, when asked the secret of his great wealth, he said, "I sold early."
I'm going to turn to audience Q&A for another question, in part because it's a topic I wanted to raise with the three of you, and that is the rise of the retail investor. It's impossible to ignore Robinhood markets, for example, the return of retail money during the pandemic. And I guess there are a number of questions I could ask, but our audience would like to know, what role has retail money played, or is it playing, in valuations where they are today? And I'll add to that, how important is it to financial stability? How important is it to capital flows? Catherine, would you like to start?
Sure. So one of the market developments over the course of our careers has been that the retail investor in this country, the retail market, has become larger than the institutional, and it's faster growing. It's over 50% of the market right now. If you threw defined contribution plans in there, which are controlled by individuals, it would be more like 75%. So the retail investor is more important as a participant in the market than ever before. When it comes to trading, that's the really important question, right? Because one thing we know about institutional investors is that they tend to be countercyclical. They have committees and boards and investment policy statements. And what you find is that institutional investors tend to be countercyclical. And as the market goes down, they tend to rebalance. They tend to buy equities when the market is down to rebalance to their portfolio weights. There's nothing that requires the individual investor to do that. We don't have boards. We don't have committees. There's nothing that stands in between us and just making a trade. And what we know about the retail investor, if we just follow fund flows, registered fund flows, which oftentimes represent the retail investor, is that they tend not to be countercyclical. They tend to be pro-cyclical. And so when the market goes down, they sell. And so the retail investor can have a very, very important impact on the overall market just because of the timing and the behavior that they exhibit.
It seems as though the retail investor is having more of an impact on the market over the past 6 or 7 months than we've seen in an awfully long time, that the retail investor is perhaps acting with more emotion, or the retail investment flows have become more short-term. Would you agree with either of those observations? Do you think there are data to support it?
Well, I guess I would point to two data points. One is that you've seen flows into bond funds at 5 times the rate you've seen flows into equity funds this year. Right. So again, back to my point about being pro-cyclical, counter-cyclical. As the market was bottoming and coming back up, you would have wanted to rebalance into equities, and yet you saw 5 times as much going in to registered bond products. So that's one thing. And then another thing is that you've just seen across both retail and institutional investors a lot of cash on the sidelines, right? $4.5 trillion in money market funds, up $800 billion year to date from both institutions and individual investors. So there's a lot of cash on the sidelines, which again provides a support. Scott talked about, expecting to see equity market prices, sort of go up in the next couple of years. There's a lot of support for that with cash on the sidelines.
Scott, I know you've spent some time thinking about the role of the retail investor. What's your perspective?
Well, I think it's symptomatic of the environment we're in, which is that a number of hot stocks have gone up, and given the rise of Robinhood and other sources to invest with, people see an opportunity to make a quick buck. I mean, this is exactly the kind of behavior that you get in manias. And when I can remember in 1998 going to a dinner party and someone asked me, "What do you think of the stock market?" I said, I go, "It's in a bubble." A year later, I was back with the same group of people, and they were making jokes about, How many more bubbles had I seen? And the bottom line, as I told them then, is, it's a lot longer than you think, and they eventually end abruptly. And so, we are moving into the mania phase. Danny Kahneman, who won the Nobel Prize in economics for his work in behavioral economics, has demonstrated that there are two sorts of regrets by investors. There's the regret of I bought something and lost money on it, and then they tend to sell them. And there's the regret associated with I didn't get my money invested, and I've seen Apple go up 100%. I ought to go out and buy some Apple so I could make some money. And so that's the risk we get with most investors, which is they're making these decisions which are designed to minimize regret, but not really doing it in a way that's rational at the end of the day.
Rajeev, the retail cohort isn't the only group that has been making a bet on tech stocks. SoftBank was such a big buyer of call options over the course of the summer. At least it was reported to have been that it earned the nickname NASDAQ whale, and rightly or wrongly, the company was blamed for exacerbating volatility and triggering the September pullback in equity markets. Help us understand what was the thinking behind that approach?
Well, you're assuming it is right. So anyway, let me explain. Nobody can move markets. And the NASDAQ futures trades 120 billion a day. Buying 1 or 2 billion or 5 billion ain't moving it. Number one. Number two, retail investors are of two types. One that go into and buy the BlackRock ETFs and put into mutual funds, which is what predominantly is happening. They're day traders on Robinhood. I don't think can move markets, over months or weeks. For a day in some stocks, fresh IPOs, small cap stocks, yes, but the entire NASDAQ or S&P cannot be moved by day traders or by SoftBank or anybody because it's just too big. So that's point number one. So it's a fallacy to think that SoftBank or anybody for that matter for 2 trillion market cap stocks or 1 trillion market cap stock by buying $1 billion or selling $1 billion can move it. Okay. As I said, we have two pockets of money. We manage third-party money, which is roughly 150, 60 billion. Some of it is in credit, but mostly equities. And then we have 300 odd billion on our own balance sheet of equities. We've divested of slower growth stocks like SoftBank Mobile in Japan. We divested 20 odd billion of T-Mobile, which I believe still is very high growth company and will be an amazing company with 5G coming for the next 2 years. It is dealing with the integration of Sprint very well. So we have another 300 billion on our own balance sheet that we manage, of which predominantly, as I said, Alibaba and Nvidia is 200 billion odd. So are we buying a few billion of other stocks to diversify away from the Alibaba we sold in the past 6 months, and SoftBank Mobile we sold, and the T-Mobile we sold? So it's a diversification. We're still sitting on a lot of cash, and it's a liquidity management strategy. It's a diversification strategy. But the big picture is nobody on this call or anybody, even with us, buying 10 billion of NASDAQ is going to, over a few weeks, is going to move the NASDAQ. So we're not even a dolphin, forget being a whale.
In some respects, Rajeev, what you describe is a microcosm of the, if you will, the inner conflict that every investor faces, the desire on the one hand to be a patient long-term investor, and on the other, the recognition that it isn't possible to make, as we discussed, isn't possible to make, or commit capital at a time when valuations are very rich. Is that to argue that in those moments, it's okay to be a long-term investor and a speculator at the same time?
So let me say this. Look, we invested in Alibaba in 99. Alibaba went public in 2014. We still own 25%. We had 33% at IPO. So we are a long-term investor in public markets. In private markets, we don't have a choice. You have to be a long-term investor. So we are a long-term investor. Your question is right. When you're sitting on 60, 70 billion of cash, earning zero, to allocate a small portion of it to liquid assets, taking a view, is a view. It's a trade. It's not a strategy. It's a trade.
At the same time as we're talking about the role of the retail investor, we should probably talk about the other phenomenon of the pandemic, and that is the special purpose acquisition vehicle, the SPAC, also known as the bank check company. Anybody in this discussion and anybody observing knows that they're all the rage. Gary Cohn has a SPAC, Richard Branson has a SPAC, even Billy Beane, the hero of Michael Lewis's Moneyball, has a SPAC, and he might take the Boston Red Sox public. Catherine, what explains, the seemingly sudden craze for SPACs?
That's a very good question. We've talked, I think, before about the fact that we've seen a persistent decline in public companies in this country at the same time that we've seen the growth of venture-backed and private equity-backed companies, so that we have more of those now than we do public companies. IPOs similarly have been falling over the decades, and this has been a really unusual year because we've seen a real dramatic resurgence in IPOs, and of them, SPACs being, a really large share. In fact, it's predicted, I'd be curious to hear what you think, Rajeev, that they could be even half of, new IPO issuance this year. So I'm not sure I can tell you what exactly is driving the growth of SPACs. I can tell you from an investor's perspective, they're kind of, from an individual investor's perspective in particular, they're sort of a complicated investment, right? Because there are parts of it that are really like private equity, because your SPAC tends to acquire a private company. There are parts of it that are like the IPO market, because of course there is an IPO. And then there are parts of it that are really like having a small or mid-cap company stock over time. So they're actually a quite complicated investment. And I'd be curious, Rajeev, to hear what you think is driving the growth of these.
So, look, listen, there are positives and negatives to every phenomenon, which is why I guess Alfred Nobel came up with the Nobel Prize. He thought the dynamite was a bad thing, but it had good uses. So let me say this. The capital markets and the financial industry has come out with SPACs, which is just another vehicle to go public. It is not short-circuiting any regulatory requirements. You still need to file an S4 and an S1. You need still to have the right governance. You still need to disclose financials and audit and have a board. So the hygiene is still there. But what people miss out is that who's the sponsor? So a retail investor who is not able to into details, it has to be made aware as to who the sponsor is, what is the company that's going into it, and what are the economics for the sponsor, how much warrants they have, how much sponsor fees they've taken. But the fundamental issue is, what is the company going in? If the company was not ready to go public, it's not going to do well, SPAC or no SPAC. I guarantee that. But that's basic law of economics. If the company and if a good company and a large company that was going to go public will go the IPO route anyways, because it'll be slightly cheaper. So SPAC is right for a good growth company which had plans to go public a year from now, 9 months from now, and uses this window of buoyant capital markets to go into an existing SPAC and save 6-9 months of wait of filing their own S1. So this is very important. So basically, what does a SPAC do? Two things: certainty of execution and certainty of valuation. Where the buyer of the SPAC, which is buying that company and merging into the SPAC, gives it a certain certainty of valuation, saying you're worth X billion dollars, and says you are done. So those are two things that get that the company gets. And the investors at that point have a decision to make whether they vote to stay in the SPAC or get their money back. Just have to make sure when retail investors then come in and buy shares in that SPAC, once it starts trading and the merger is done, that is the right company. And that sometimes gets lost today. But last statement, 40 billion of money has been raised in SPACs so far, as a rough number, which means they can buy companies worth 5 times 200 billion, because 20% is the float, right? So 5 times. So if we have 200 billion worth of market cap of companies, 40 is large, but it's not an enormous number. I mean, in 2 weeks, Ant Financial raised 25 billion in one IPO.
Rajeev, is there a role for a SPAC or perhaps even multiple SPACs as a distinct source of capital alongside the Vision Fund, the Vision Fund 2 for a company like SoftBank? Is there any appeal there for you?
No, I told you, our problem is to find investment opportunities, not to raise capital. We have too much liquidity right now. Our problem is, again, the SPAC has to have the right investment opportunity inside it, of which one of the companies, Bike, that we had 10% of, went public and has gone up 10 times. It's a Chinese real estate company. It's at 75 billion valuation. January, we invested at 10 billion. So the problem is not to come up with financial engineering to raise alternative sources of capital. It's how do we deploy it right now?
So, Scott, is the SPAC an investment vehicle whose time has come? Is it, as Rajeev just suggested, perhaps a little bit of financial engineering? And can it be either of those two? Okay, perhaps forgive me for misinterpreting Rajeev, but let's just say, is it an investment vehicle whose time has come, or is it merely a manifestation, of speculative excess?
Well, I think, speculative excess is, just like in other areas, is accelerating its growth. But, the SPAC as a vehicle, I think, is ultimately going to be transformative for the capital markets in a way that was similar that high yield bonds became transformative for the capital markets. There were lots of fits and starts, in the early days with and building the business that he built. Of course, later on, there were a lot of abuses in high yield bonds of companies that really shouldn't be borrowing money in the capital markets, getting cash. But just like this, the SPAC, the history of SPACs is a pretty dismal one. Of all the SPACs that have been done, over 70% of them are lower where the IPO on the SPAC was. And I think that that has to do with two things. One is a lot of the money is coming out of the retail sector because, investors like us would say, well, wait a minute, this guy's going to get 20, he's going to dilute by 20%. And, he also is, got warrants on the deal, which is going to dilute us further. And, what's so special? Now, the Bill Ackman's back, where Bill basically bought warrants and is putting up capital out of his fund, where he will make the money on it from his fund shareholders. So I think that as we evolve, it's going to, and it becomes more of an institutional vehicle like Bill Ackman has done, versus three guys in a garage with a dog deciding they should do this. I think the quality of the SPACs will go up and they'll gain more respectability with institutional investors.
So let me add one final point. So there's no, and again, Scott put it rightly. The way companies raise money from the capital markets is changing anyways with direct listing. Direct listings being allowed to also raise capital with direct listing, and you bypass the investment banks, which is disruptive and great, because why leave money on the table? So SPACs will do that.
I see.
Yeah, and I think to follow on to your question about how will this amazing marketplace of SPACs that went from raising 4 or 5 or maybe 10 billion a year to 40 billion this year, whenever you see growth like that, you're going to see winners and losers, and I think that's particularly the case here, because remember that this is a way for the retail investor to access this market that some of which has this private equity type focus because of the acquisitions by the SPACs in a way that maybe they couldn't otherwise, because to invest in a private equity or a venture capital fund, you have to be a qualified purchaser, an accredited investor. You have to have more resources. So there will be winners and losers. The market is broadening. It's much larger. And I even noticed over the weekend, there are some ESG SPACs out there. There's even an ETF now for SPACs. So, we will have to watch the space. Scott is absolutely right. In the past, returns were not stellar.
Yeah, it will be froth. There is froth. But what's key is there alignment of interest? Is the sponsor putting in money? Is the sponsor taking out too much without putting in any money? Those are the things you have to watch. Company that's inside the SPAC, a real business. Every SPAC has only one investment in it, one company in it. It's not some portfolio of companies. So it depends on the size of the company. So let's take a hypothetical example. There's a great growth company which needs to raise $500 million or $1 billion, whatever it is, $500 million. Valuation is $3 billion, hypothetically. Believes they can go to the public markets in the next 9-12 months, and we say, look, we want to invest in you at that valuation, and the company says yes, but I also want to go public because I want to raise a bit more 9 months later. So SoftBank, why should we take 500 million from you when I can go just do an IPO and raise $1 billion? I said, look, we will put 500 million in you, and we can go to the public markets and raise another 500 million. But our 500 million is committed at this valuation, and we'll sponsor you to go public through a SPAC and raise the remaining 500. It's not a fund or anything. It's just an investment in a company. It's one asset.
Before we run out of time, one of the issues that we haven't touched on is the election. And I would like to take at least 90 seconds to 2 minutes from each of you before our time is up to ask you what you think the looming U.S. election on November 3rd means obviously for fiscal policy, what's at stake there, what it means for the economy, but ultimately, since this is a conversation about capital markets, what it could mean about capital markets. Scott?
Well, I think the resolution of the election will in and of itself be positive for the markets. Now, the question is to which degree. At this stage of the game, the market seems to be betting on Joe Biden. If you look at stocks that we think would flourish under Biden versus those that would flourish under under Trump, that they are performing much better, like alternative energy companies. So I think a Democratic will probably be in the best interest in the short run, because there'll be lots of stimulus, the reduction of risk premium from who is going to be our next president. I don't see it in the near term being the disaster that a lot of people are proffering in terms of having a Democratic administration.
Rajeev, what about you? What do you think's at stake in this election for investors and for markets?
Okay. With the disclaimer that I'm not a U.S. citizen and I'm sitting here in London, but we live in a global world where the U.S. And China decide the state of global markets and the economy. I think, as Scott said, certainty is better than a closed election. So any form of certainty, one way or the other, is good. whether corporate tax rates are 21% or 27% before they were 30% is not, it's going to have some impact, but it's not going to be night and day. I don't think either way, there'll be too much disruptive taxation when we are going through an economic crisis because of COVID. I think an aligned Senate and White House would have tremendous opportunity for further stimulus, not just stimulus in January, but in March and April, because the vaccines and return to normalcy will take 9 months, a year. Okay, but it's not just stimulus. It's not just the Fed. A big spending on infrastructure will create jobs. Will help the economy in many other ways. So, I think, as Scott said, an election which is decisive one way or the other is what the market wants. Bottom line, they don't want a close election, and hence that's good news.
And Catherine, explore for us your thinking, or share with us your thinking on the implications of this election, what it means for investors in the markets.
Sure. So for individual voters, elections might be about politics, but for the markets, it's really about policy, right? What are the policies that are going to be adopted by the new administration? And I think in the near term, the policies will be around stimulus, right? We still have an economy that's 10% smaller than it in the beginning of the year. But longer term, the policies that are going to matter are going to be about regulation of industry. It's going to be about tax rates for individuals and companies. And it's going to be about globalization, deglobalization, and the future course of our relationship with China, the second largest economy in the world. So that's what's going to matter in the medium term.
Would you expand on that last thought? What is going to happen to America's relationship with China? And is the standoff between the two countries going to evolve into a standoff that begins to affect capital flows?
Well, we will see, right? We will be dealing with trade and technology and supply chains and healthcare. Some of that is already in flight. So we will see. We will see.
Little too early to make predictions. I don't blame you. I want to respect the countdown clock and take this opportunity to thank all three of our panelists: Catherine Keating from BNY Mellon Wealth Management. Excuse me, Catherine. Rajeev Misra from SoftBank, and of course Scott Meinert from Guggenheim. It's been great to have you here at the Milken Institute's Global Conference 2020 panel on capital markets. A lively, spirited discussion, lots of points of view. I think enlightening for all our viewers, and I look forward to my opportunity to speak with each of the three of you again. Thank you, ladies and gentlemen.
Thank you. Thank you.
Thank you.
Thank you, everyone.
Thank you.